Do you own your own home yet? If not, are you wondering how you would be able to afford buying your first home? Are you wondering the type of tax credits and plans you can potentially take advantage of when you're buying your first home for the first time? If you own your home already, have you ever concerned about how your next generation is able to afford their homes in the future? Or if you are recently divorced or separated from your common law partner, are you aware of any tax incentives that would help you to purchase your next home on your own? Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Toronto, Ontario, Canada. I'm on a mission to help hardworking Canadians seeking financial freedom. Earlier this year, I did a video on how to buy your home with little money, and the link is up there. You can check out the link above. I discussed the various government incentives and strategies that you can potentially use to help you purchase your home. On top of all the incentives mentioned in the previous video, the Canadian federal government also announced the introduction of a new registered saving account called Tax-Free First Home Saving Accounts, also known as FHSA, in Budget 2022 in an attempt to help Canadians purchase their first home. Recently, the government had released the first draft of the legislation to discuss the ins and outs of the design of this tax-free first home saving account. Before I dive deeper into this tax-free first home saving account, make sure you hit the subscribe button below if you want to stay on top of the latest tax tip and latest wealth hack. Don't forget to give us a thumbs up if you find this video useful and share with your friends who may be considering buying his or her first home, or if they are in the process of getting separated. Please note that all the information presented is based on the draft legislation released in August 2022. Now with that, let's get started. What is a tax-free first home saving account, FHSA account? As one of the many plans to help Canadians acquire their first home, the federal government announced in Budget 2022, March 2022, the creation of the First Home Saving Account. The idea with the tax-free First Home Saving Account is that qualified Canadian taxpayers make contribution to this tax-free First Home Saving Account and have a tax deduction against their personal income. But how does it really work? Well, FHSA allows qualified first home buyers the ability to save $40,000 on a tax-free basis, and this $40,000 is a lifetime contribution limit, meaning that you can only contribute up to $40,000 in your whole life. And the maximum annual contribution limit of this account is about $8,000, so you cannot contribute more than $8,000 unless there is a carryover amount from prior year. Contribution to the plan can be tax deductible, similar to the contribution you would make to your RRSP account. So if you contribute $8,000 in 2023, that $8,000 could then be offset against your income. Withdrawals to purchase a first home, including the investment income you've earned within the FHSA account, is not taxable, similar to a tax-free saving account. An expected date of introduction of this account will be sometime in 2023. Regardless when the official legislation comes out, qualified Canadian residents would still be eligible to contribute the full $8,000 annual limit in 2023. Now, who's considered as qualified first-time home buyers for FHSA account? Well, this may surprise you. You don't need to be the first-time home buyer to qualify. To qualify to open this first-time home buyer saving account, you have to meet the following criteria. First, you have to be at least 18 years old. You must be a first-time home buyer, meaning that you have not owned a home that you lived at any time during the part of the calendar year before the account is open, or at any time in the preceding 4 calendar years. Now, this means that if you own a rental property and you've always lived with your parents, and you will still be eligible to open this FHSA account, even though you already own a home, because it is a rental property. It's not really a property that you lived in. In 2020, the first-time homebuyer definition has also been expanded to include taxpayers who are separated, divorced, or experience a common law partnership breakdown. At the time of withdrawal, taxpayer must be living separate and apart from their spouse or common law partner because of relationship breakdown for a period of at least 90 days or the previous 4 calendar years. So you must be living apart from your previous common law partner or spouse for at least 90 days to qualify to use this FHSA account. Now, how does FHSA account help me buy a home? Well, let's use an example to explain. Let's say you're currently making about $100,000 from your day job and you meet the definition of first-time home buyers that we mentioned earlier. You're not sure if you would ever buy a home on your own, but you do believe in saving, so you decide to open the FHSA account in 2023. You open this account and then contribute $8,000 annually for 5 years, reaching the lifetime contribution limit of $40,000. So from 2023, you contribute $8,000, 2024, you contribute $8,000, all the way to 23, 24, 25, 26, 27. Every single year, you contribute $8,000 into this FHSA account. Remember that our Canadian personal tax system is a progressive tax system. So the more income you make, the more tax you would have to pay. At a $100,000 salary level, your marginal tax rate in Ontario currently is 38%. So when you make the contribution to the FHSA account, similar to RRSP, the $8,000 that you contribute would give you a tax saving of $3,040, being $8,000 multiplied by 38%, which is the highest marginal tax rate that you're subject to. And so you get a $3,040 tax saving. Assuming you're making the same amount of income the next few years, and assuming that the marginal tax rate stayed the same, more or less the same, over the next few years, each year by contributing $8,000 to your FHSA account, you get to save $3,040 taxes. 5 years later, you get to save a total of $15,200 personal income tax. That's nice, isn't it? This tax savings from contribution is similar to RRSP. Now, let's say you also invest these amounts into stock market, earning an annual dividend yield of 5%. Some of the big 5 banks are currently paying 5% dividend yield, so it isn't uncommon to earn 5% dividend yield these days. By the end of the 5th year, with compounding, you will have $46,415 left in this FHSA account. So you invested $40,000 and there is an additional $6,415 left from your dividend income. Now, I'm not accounting for any potential capital appreciation. I'm just assuming that the stock is going to stay at the same price. So let's say you only increase your balance by $6,415. If you are still undecided as to whether you will be buying a house for your own use, at that point, you can keep this FHSA account open. It will only die at the earlier of you turning 71 or the 15th anniversary from the day you open your FHSA account. Now, say 10 years from now, you're interested in buying your own home for the first time. At that time, the balance of the account is, say, $85,000. You can withdraw this $85,000 completely tax-free. Neat, isn't it? You save $15,200 personal income tax on the amount that you contribute, and then you also save the taxes on the additional $45,000 investment income you accumulated in the account. Using the same tax rate of 38%, tax savings on investment income you earned within the FHSA is about $17,100. So total tax saving, combined total tax saving is about $32,300. That's a lot of tax saving. What if you never end up buying a home then? If you never end up buying a home before the end of the 15th anniversary of your FHSA account, you can choose to transfer all your investments within your FHSA to your RRSP account on a tax-free basis. The transfer will not reduce or be limited by the available RRSP contribution room. So as you know, RRSP, the amount that you can contribute to your RRSP is really capped by the RRSP contribution room. Even at the end of the 15th year, when you have to wind up this FHSA account, you may not have the available RRSP contribution room. The transfer would not be limited by the unavailability of the RRSP contribution room. Now, you can also choose to withdraw the amount from your FHSA account at that point, but the amount withdrawn would then be taxable, similar to RRSP withdrawal. Now, how does this compare to the home buyer's plan available within the RRSP account? Well, you can't use the home buyer's plan to purchase your first home and use first-time home buyer saving account at the same time. So, which means that you can only choose either the home buyer's plan or the FHSA account at any given point. Now, the home buyer's plan allows a first-time home buyer, which is the same definition as we mentioned earlier, to withdraw up to $35,000 from his or her RSP account to purchase their first home without triggering any tax on the withdrawal amount. The first-time home buyer definition is the same as what we discussed earlier. Now, the amounts withdrawn under the home buyer's plan would have to be repaid over a period of 15 years, starting second year following the year of the withdrawal. If you miss an annual repayment, the minimum repayment amount would then be included in your personal income tax return of that particular year. So the bottom line, timing matters. Now, taxpayers will take about 5 years to max out on their FHSA lifetime contribution limit after the legislation comes into effect. There's a maximum of $8,000 you can contribute on an annual basis. If you are a planner and a saver, start early, save early, and FHSA is the way to go. You would choose to borrow against FHSA. Save your first-time home buyer money within your FHSA. Now, home buyer's plan, on the other hand, can be done in the same year before you purchase a property, assuming that you have the RRSP contribution room available. If you are the last minute person like I am, and you have limited amount of FHSA contribution room available, it may be more beneficial to just go with HPP withdrawal instead. A few things you need to know about contributing to FHSA account. You have a maximum annual contribution limit of $8,000. You cannot contribute more than that amount. If you miss an annual contribution, you can only carry forward maximum of $8,000 to the following year. This means that you can contribute a maximum of $16,000 in year 2. However, if you miss year 2's contribution as well, the maximum contribution room you can carry forward to year 3 is still the same $8,000. So in year 3, again, the maximum you can contribute is up to a maximum of $16,000. So you can never carry forward for more than $8,000 contribution limit. Now, the lifetime maximum contribution limit is $40,000. Once you hit that, it's never going to come back to you. If you withdraw the amount for the qualified purpose, meaning buying your first home that you're going to live in, you can withdraw the amount in your FHSA, including any accumulated investment income, tax-free. No tax at all. Now, unlike RSP, your contribution to this FHSA account has to be done in the same calendar year. You do not have the flexibility or ability to contribute to your FHSA account the following year, unlike RSP, because RSP allows you to contribute to and be applied against your prior year income. You can make your contribution up until the end of February of the following year. But FHSA, there is no such flexibility. You have to make the contribution in the same calendar year for it to be counted toward that particular year's FHSA contribution and being deducted in the same calendar year's tax return. Now, interest on money borrowed to contribute to your FHSA account is not tax deductible. That's just the same as RSP and TFSA. You can invest your FHSA the same way you invest your money in your TFSA and RSP account. Now, the type of investments allowed in this FHSA account is similar to that allowed in RSP and TFSA account. You can invest in stocks, qualified real estate investment trusts, private lending, mortgages, bonds, etc. You won't be able to own a home directly within your FHSA account. That's the same, consistent with all other registered accounts. You'll be paying 1% tax on any over contribution to your FHSA account. And I'm talking about 1% per month of tax on any over contribution. You can have multiple FHSA accounts with multiple institutions at the same time. But the combined total of contribution should be less than the annual contribution limit. So you can have one FHSA account with institution Bank A and then another with Bank B. But the contribution you make to Bank A plus the contribution you make to Bank B cannot exceed that $8,000. As you can see, a first home saving account can provide significant tax advantage to Canadian taxpayers who are still looking into buying a home. Now that you have learned so much about this upcoming FHSA account, let me know your thoughts on how this could help you or the next generation or your friends who are recently divorced to buy their first home. Just a word of caution though, the information presented today before is based on the draft legislation released in August 2022, and the FHSA account will be launched officially and available sometime in 2023. So final legislation will be released at that time as well. So make sure you refer to the future video and make sure you hit the subscribe button to stay on top of the latest legislative release. Until next time, happy Canadian real estate investing.